Drew, do you have me?
You hear me okay?
I got you. Can you hear me okay?
Good. I can.
So we assume
It's
everybody else can hear us okay?
Well, it's 3 o'clock, so I say we get started, huh?
That'd be great.
Well, hey, everybody, welcome. My name is Drew McMillan. I work with Jeff. I'm one of the financial planners on Jeff Dovine's team, and we work with Southwestern Investment Group, a lot of great financial advisors and financial advisory teams. So a lot of our clients, personal clients here on this call, and maybe some clients from other advisory teams here. So just wanted to say welcome to everybody. We wanted to put this on because we know there's a lot going on in the world right now, and there's a lot to be nervous about. And there's a lot in the news that's telling us a lot. And then there's a lot of great investment lessons that, you know, I think that we can point to and look at history and learn about how to do this well, how to navigate this well, how to potentially take advantage of maybe some opportunities that are here, and what just good, successful investors should do. So we got a lot prepared, a lot to dig into, and we're excited to do it. So I'm going to hand it over to Jeff. So Jeff Dovine's the president of Southwestern Investment Group. And we're going to kind of go through quite a bit of stuff here, but it'll be fun, I promise you, and educational. So Jeff, I'll have you take it from here.
Great. Thanks, Drew. Well, welcome. It's beautiful in Nashville. It's 70 degrees. So on a Friday afternoon, thanks for joining. Even I see my mom has signed in, so I guess they don't have anything to do in Southern Ohio with the lockdown except to listen to a little investment update. So Mom, thanks for joining. A couple housekeeping items. We will record this so then we can email it to everybody that's signed in, and feel free to share. Also, Drew will kind of be managing some questions, so Q&A. So somewhere on your Zoom is a place to type comments or questions, and we'll try to do our best to get to them all. And then if we can't get to them all now, we will be sure to follow back up with you. So thanks for that. We will try to make this about 40 to 45 minutes of the presentation and then some Q&A. And then we'd love to chat with anybody afterwards if you have any questions. So it has been an interesting time. And so our team and the whole group of Raymond James has spent the better half of the last couple of weeks researching and looking back at different pandemics and different market corrections. And obviously this is different. The pandemic is different. We still don't know what the world's going to look like. But Sir John Templeton, who is one of the most famous investors, said the 4 most dangerous words in the investment vocabulary is "it's different this time." And so we wanted to go back and maybe share how our country, our government, how the markets have behaved over the last 70 to 80 years. We have 4 significant big bear markets that we're going to study and review. And then obviously there's some difference changes, some things that we can implement to be sure that we're navigating this well. So thank you for joining. With that, I will cover a little bit of what the market histories have done, what we think the government is doing, and what the future might hold, and some good strategies. So we'll cruise through this. As I mentioned, COVID-19 is obviously radically different. This is the first time ever we've had a state of emergency in all 50 states, but it is different this time, but that doesn't mean that the end game will be radically different. We wanted to go back and review some of these past pandemics, and I think this is really fascinating. Polio in the late 40s and 50s had 57,000 cases, over 3,000 deaths, and 21,000 sadly disabilities. We had a teacher in school that walked with crutches from polio when I was in junior high and high school, so that was a devastating issue. H2N2, which was also called the East Asian virus in the late 50s, had 1.1 million worldwide deaths and 116,000 of them in the United States. And then a little more recent was the swine flu in 2009. Obama declared that a national emergency, over 22,000 cases and 4,000 deaths in the US. So how the stock market survived through these past pandemics. It's CPI is the inflation. And so in 1949, inflation CPI would have been 24. As of the end of March 31, it was 259. So inflation has grown by 11-fold. The S&P, on the other hand, was at 15.36, which is interesting in 1949. As of the end of March, it was 2,586. So the stock market has increased by 168 times. And as Drew mentioned earlier, the growth has been annualized 7.3% from that period till today, plus dividends. So when you add the dividends, it puts you close to 10%. Wow, Matt, that I just wanted to give a little context for everyone. So from the peak of the market to the bottom of the market, the S&P was down 38.4% over the last 6 weeks or so. It's been up 31.7% as of last night's close, but still down for about 18.8% from the peak. So just to put that in context of where things have been and where we are. Go back and look at the Great Depression, and this is something that our government has really done well at studying some of these things, particularly recently. The cause, inflated stock and real estate prices. How do we get in this depression in 1920s? Excessive leverage, massive margins on assets, no bank guarantees on deposits, no FDIC insurance, no SEC regulations, no Fed or congressional intervention to stimulate the economy. And look at the impact that that had on the markets. GDP declined 26.7%. Unemployment was 20+%. Deflation was over 30%. And we had massive pessimism and loss of confidence. More recently, the Great Recession, 2007 through 2009, we had financial deregulation led to, as many of you know, folks buying mortgages and mortgaging many buildings and real estate with very little, if any, money down, which causes radically inflated real estate bubble. Subprime mortgages, shadow banking, excessive leverage, debt out the gazoo, and systematic breaches in accountability and accounting, if you remember Enron and Arthur Andersen. The result of that was GDP declined 5.1%, unemployment was over 10, and deflation was none. We're going to talk a little bit about what the deflation looked like. And when you think about it, although the Great Recession was awful, it started in 2007 and lasted until March of 2009, the last year of President Bush, the election of Obama, the inauguration of Obama in January, and then that apology tour that kind of happened in January, February, March, as folks call it. But the market was dropping precipitously through March of 2009. But the government learned, and Bernanke, who studied the Great Depression, who took over as our Fed chair, studied the Great Depression and made some severe changes that really caused the Great Recession to be less severe. So monetary policy, interest rates, they dropped radically. Liquidity was increased significantly. So when monetary policy, the fiscal government spending increased and taxes were decreased. And so if you'll remember, all those things happened. One of the challenges, though, is they took a while. Although all these policies were implemented, banks were under so much scrutiny, they couldn't really lend money when people needed it. And one thing that's really been impressive to watch is how quickly the government has stepped in to assure that people, in fact, we had a firm that we work with that had already received, as of 2 days ago, their PPP money from the IRS, and it was $6.2 million to cover their payroll for 2.5 months. And so it's just fascinating how much more quickly things have happened in this dramatic issue than it did in the Great Recession, which it infinitely learned from the Great Recession. The bear market of the 1930s, the 1970s, and the 2000s. We're going to look at a few portfolios, definition of different asset classes. So how do you try to protect and be successful investor throughout these periods? There's 5 general asset allocation plans that we have in this illustration here, representative of different asset classes, just some housekeeping. The stocks are represented by the S&P, bonds represented by the long-term government bonds and treasury bills. So in this illustration, we want to show an aggressive portfolio just as an example, although most of us don't have clients with 100% of the money in stocks, because bonds, particularly for folks that are not young, that are in their 20s or 30s, that are really trying to have some income, we need to incorporate bonds to reduce that risk. But we have 5 models that we've illustrated here. The most aggressive would be 100% stocks. The most conservative would be only 20% stocks. And then we have 3 other samples here to look at. So during the Great Depression, just a quick reminder again here, 25% was the peak unemployment, double dip recession. We had the war going on and deflation. And we wanted to look, what did that decade look like from a stock market performance? What were bonds doing, and what were T-bills and interest rates? So take a look here. This was the only period of time that a decade from beginning to end did not return a positive return with the S&P 500. And it lost 0.06% per year on an annualized basis, so roughly 1% over that 10 years. Long-term treasury bonds were at 4.8, T-bills were 0.5, short-term interest rates were very low, and unemployment rate was 18%. So that was a rough decade in which to live or to be an investor. But even looking at that, if you'll remember, this red line is 100% stock portfolio. And that was the only portfolio in our illustration that actually lost money from 1930 to 1939. So if you had a diversified portfolio of any form and incorporated bonds at all in the portfolio, you actually made money from 1930 to the end of 1939. And when you consider that if you have any bonds in your portfolio at all, you made somewhere between 30 to 46% over that decade. That's fascinating, and I think that's the reason why we should have a lot of confidence about investments going forward. Taking a look at 1970s, this is another example. Probably everybody on here will remember these things. Wage price freezes. We had the whole Nixon issue with Watergate, which caused his resignation. Oil embargo, OPEC oil crisis, Vietnam War, New York City nearly filed for bankruptcy, 3 Mile Island, hyperinflation. So these were fears that were real, that were happening at that time. But to look from 1970 to 1979, the Standard & Poor's had an average annual return of 5.86% per year. Long-term bonds were nice as well, 5.1, and T-bills were 6%. The problem, however, is you'll remember if you were trying to finance a home at that time, is interest rates averaged 8%. Inflation was nearly 8% at 7.3, and unemployment rate was over 6%. So while the markets averaged a decent return, you were getting clobbered with inflation. However, look at these different portfolios over that decade. And again, this was a pretty brutal decade, maybe the lost decade. And so $1,000 in all 5 of these scenarios grew somewhere on average from a low of 76% cumulative to nearly 83%. Drew, any questions there so far? Then the 2000s. So if you'll remember, this was the great go-go years of Clinton. In the 90s, if you had a .com next to your name, the stocks were going through the roof. It didn't matter if you had made any money or not. In fact, I think the less money you made, the more appealing you were to investors back in the late 90s. But the .com bubble was catastrophic, obviously. And then right thereafter, we had the September 11th terrorist attacks. Then we went into the war in Iraq. And as we talked about earlier, we had Enron, followed by WorldCom, Arthur Andersen, all gone, eliminated. We had the housing bubble of 08. So this was kind of a bookmark of 2000, and then a catastrophic event with 07, 08, and 09. However, the Dodd-Frank Wall Street Reform and Consumer Protection Act took effect. And so this is actually, Dodd-Frank is what's really helping now with US banks are not at massive risk because of some of the protections that took effect in 2008 and thereafter. But take a look here at the market from 2000 to 2009. Standard & Poor's lost 0.95%. So this was the only other bookmark to bookmark annualized loss of slightly 1% cumulative. Long-term treasury bonds made 7%. So if you were in bonds exclusively, you had a really decent return in the 2000, 2009. Short-term interest rates were average around 6%. relatively low unemployment and relatively low inflation, similar to where we are now. And if you took an average portfolio of varying degrees of risk, even if you invested at the peak or shortly after, I guess that would be the crisis of 2000 through the end of 09, you again only lost money. If you had an aggressive portfolio, you lost $100 on 1,000 over that decade. Any diversified portfolio at all made money, and a more conservative portfolio actually was up 73% for the decade. So now bringing it in to a 90-year bull market, stock market, and part of the question I think a lot of us have is like, why is it worth it? Is it worth these roller coaster rides to deal with some of this trauma of what the stock market does? And I guess we're here to encourage and show you statistically that it's well worth the hassle and the headache and the stress, because the stock market is the only thing that's added real wealth in the United States of America over the last 90 years. So if you invested $1,000 in 1930, a conservative portfolio today would be worth $260,000. Conservative growth would be 607. And it looks like these are all similar here, but obviously this is a logarithmic scale. So it goes from 1,000, 10,000, 100,000, so it can fit on the screen. But look really at the difference. A moderate growth portfolio would have grown to 1,804,000. Every $1,000 has grown to 1.8 million. If you were ultra conservative, instead of 1.8 million, you were at 2.6 million, excuse me. This is why I need Drew to run the slides here. I hit my mouse, sorry. So if you were a more aggressive investor, then you doubled your money yet again, and we're somewhere in the $3 to $4.5 million, depending on your time horizon and your risk tolerance. So, but average portfolios, and again, this is going all the way back to the 1930s to 2019. I know a lot of us are saying, well, that's great, Jeff, we don't have 60, 70, 80 years of retirement, but I want to share that this is the type of returns that we want, and we'll get to in a minute, regardless of what our time horizon is, as long as it's not ultra short term. And that's what our emergency funds are for. So an aggressive portfolio, just to put in here, is an average annual return of 9.8. Growth portfolio with the little bonds was 9.4. A moderate to conservative growth would have been somewhere in the 7 to 8% range per year on the average of the last 90 years. Quite impressive compared to money markets or CDs. So we got
Jeff, I just wanted to tell everyone that if you do have a question, I see somebody raise their hand. If you do have a question, at the bottom of your screen, there should be a Q&A button. So if you could type in your question, we'll be sure to answer those as they come through. Thanks.
Thank you, Drew. So a couple key takeaways here is a broadly diversified portfolio of really good quality stock mutual funds, ETFs, incorporating bonds helps obviously mitigate the risk over the long term. And I think what we wanted to try to do here is, we'll come back to that slide in a second, but we've seen this, I've worked with clients over the last 22, 23 years, and that was pre-dot-com bubble, then pre-07, 08, 09, and now pre-2020. And you do really enjoy when you work with people to really internalize what these emotions are. And I think this is really fascinating. And just go back to that dot-com bubble of this roller coaster of emotions. And excuse me, a lot of optimism in the late 90s. It was kind of like, why diversify? Why not just put it all in a dot-com stock? Because everybody's making money at all times. Then we get pretty excited, and then it starts to become thrilling. And this is when people were doing day trades all day long when their 401k plans while they're supposed to be working, to get to euphoria. And then right about here is the market correction of the dot-com bubble burst, and you see people becoming anxious, then denial, then fear, depression, panic. Then they just throw their hands up and say, this is crazy, capitulation, despondency, and ultimately depression. But I think right here is something that, as Drew and I have been really working with folks, it's trying to go back and say the point of maximum financial opportunity is when people are depressed and scared. And we don't know that obviously the market bottomed out 2 or 3 weeks ago, but that was, at least in this short little window, was the point of maximum financial opportunity, was also the maximum fear and depression and emotional decisions. And so when you think about it, when you're investing and buying in stocks, obviously the goal is to try to buy these companies when they're cheaper than when they're more expensive. And so from an investment perspective, we want to always be buying when we're at maximum financial opportunity, which is when the fear is the highest. And Drew's always quick to remind us of Warren Buffett's quote: we want to be conservative when others are greedy, and greedy when others are scared. And is that exactly it, Drew?
So we want to be greedy when others are fearful, and fearful when others are greedy. So pretty close.
Drew and Buffett say it better, but that's exactly right. And so then that starts this cycle all over again of a little bit of hope turned into relief, thankfully, that the world didn't end and the markets didn't collapse and the biggest, best companies in the world didn't go out of business. And then we revert back to optimism. The challenge, of course, then you go right back into this same cycle over time. So are investors irrational? When you're thinking, obviously, of your investor return, you solve for that by performance of investment. So this is the responsibility of the institutional managers and financial planning teams. But you take the performance, and we need to obviously include investor behavior, and the responsibility of the client and the financial advising team to really say, how do we make the best of this? And you add those two together, and that nets the return. And so our goal is to be sure that our teams are walking with investors to make good, rational decisions, even in spite of the fear. So we want to be a voice of reason and hope. Speaking of that, this is the past economic sentiment, and it really is fascinating when you consider this. So stick with me here for a second. So red is how people were feeling in the United States of America about the economy. And this goes back to 2007. And isn't it amazing that in 2007, 2008, and 2009, roughly 80% of Americans felt negative about the economy? That's not hard to understand when you consider how many builders were going out of business and how many foreclosures there were. It was a tough time in the markets, and then even more challenging kind of out there in the real world. But that negative view did not go down and did not become at an equilibrium with people that were optimistic about the U.S. economy until all the way 2016. And we'll show here what the markets did during that period. But there really is a dichotomy about what people feel the markets should be, or what the economy is, and what the markets have done. So even though the last few years, the S&P, if you'll see here, from March 9 of 2009 through the end of last year, was up 482%. So the last decade, the market was up 482%. But investors withdrew $1.9 trillion from stock mutual funds over that 12-year period. So this red line represents people withdrawing money out of the stock market and stashing in their mattress or putting it in bonds or doing something more conservative. Meanwhile, the S&P was up 482%. And the thing that we really want to try to help people understand is, if you go back here, people were feeling fearful and negative about the market and the economy. Meanwhile, the economy had one of the greatest booms in the history of the United States, of 482%. And they actually not only felt this way, negative, but they were acting on it by withdrawing $1.9 trillion from stock mutual funds. And this slide, just another example of people were taking 1.9 trillion out of equity funds and adding 1.8 trillion to bond funds since 2007, even though the market was up 482%. This is just a really good indication of people doing the exact opposite of what they should be doing because of fear. The stock market was up 31% in 2019. That same year, taxable bond funds returned 8%, And yet $92 billion came out of stock funds last year, and $415 billion went into bond funds. So people have been fearful and have been obviously losing out on the returns of the market over the last decade. Another Warren Buffett quote was, "Money is like soap. The more you handle it, the less you have." Drew found several Buffett quotes, and we thought this one was get a kick out of it. So money is like soap. The more you handle it, the less you have. So another key takeaway is it's very easy to get emotional with all the money given the headlines. I had a good friend and mentor tell us that, have you considered turning off the news and turning on the music? And I know it's easier said than done, but man, it really is fascinating. If you watch some of that, one of our fears is people are home, and I know when I turn on the news for a little while, it can be devastating. And I'll come in, and Amy will remind me that I need to taste my own medicine and turn off the news and turn on the music. This too shall pass, and the markets already, as we said, in the last 3 weeks, are up 31.7% from the bottom. So how long can stocks be down even during these bear markets? That's obviously the question that we don't know the answer to on this particular one, but I do think, again, the history seems to rhyme, although it doesn't repeat, it does rhyme. And so let's look at these going back again to the Great Depression, which was obviously a horrible time for the markets, down somewhere around 80%, 80 from the peak to the bottom. Even if you did nothing, so it started in 1928. If you did nothing, all of the money was recovered for those investors in 4 years, 4 months. A $10,000 investor, if they added another $10,000, then they recovered their money in 3 months. If they sold out at the bottom, obviously they realized a loss of 78%. Check out this 1 year recovery from the bottom was 137%. Obviously, we don't anticipate that's going to happen this year, but it is reason for hope. The oil crisis. Yeah.
We had a couple quick questions, just maybe we hit these on the equity outflows and inflows. One question was, is there any way to tell how long the outflows happen before inflows come back in? So kind of how long is a typical equity investor out before coming back in? And then the other question was, do we think some of that switch was baby boomers moving out of equities and into more conservative investments as they are getting closer to that retirement age where they need to start recreating their paycheck from their investments?
Yeah, there's certainly some of that. The big issue, though, is going back to investment behavior. And Drew and I study a Dalbar study. Really, we've been studying that for probably the last decade or longer. And it's fascinating to study what the average individual investor has typically returned about a third of what the average institutional investor has. And it's because we tend to be, the phrase that Drew and I used to use a lot more, and we'll be using it again now, is trend chasing behavior. And so I think what was happening, as you can see in that decade of the 2009, and then from 2009 till now, people were still withdrawing significant amount of money from bonds, but that trend has happened because people don't feel good about the economy. That's happened long before baby boomers were we're getting into retirement. So the challenge will be, as we're talking to friends and family and neighbors, and we'll get to this here in a second, Drew, but the headlines drive a lot of what the average individual investor does. There's very few people, unless they have a really astute financial wherewithal or a good coach and financial planner to walk with them, that understand some of the concepts now, that these are the times, obviously, to rebalance and to consider buying more as opposed to getting more conservative, even though the news is not too ambitious. That answer those, Drew? The oil crisis of 1970 to 76, the markets were down about 44%. And just an example, again, if you did nothing, you recovered all of your money in 1 year, 8 months. If you doubled down at the bottom, because those shares were bought so cheap, your total portfolio recovered in 5 months. If you sold out and moved to cash, you realized a loss of 44%. And the recovery from the bottom in that crisis as well was 44.46%. So here we are showing these again, a 75% return, a 90% return, and then a peak to peak trough, peak to trough to peak of the Great Depression, the oil crisis, the internet bubble, and the 07-09 crash. And again, depending on where things go with this COVID-19, there's a chance based on where we are right now that it will not take nearly this long. But these other cycles took somewhere around 4 years, 1 year, 3 years, 6 months, and 4.4. The average is only 141 days when we have a bad pullback. The only exception would be these crises of the Depression, oil crisis, internet bubble, and the 07-08. This is a chart that Drew and I have studied off and on for years, but boy, it really has been fascinating and enlightening. And so stick with me here for a second, because this is truly mesmerizing, and at least to nerds like Drew and I. These are the last 7 significant pullbacks and what the market looked like from peak to trough. A loss of 35%, 19% in the Gulf War, Asia monetary crisis in the late 90s with 19%, the tech bubble, as we talked about, 49%, financial crisis from the latter half of 07 to March of 09 was 56%. We're going to come back, and if you remember these two numbers here, lost 56%. The next year, the markets were up 68.6% from the bottom. We're going to come back to this on the next slide. The debt downgrade, this is when Standard & Poor's downgraded the U.S. debt from AAA to AA. People were worried if the government was going to default on all of our debt. So for the majority of the year, the markets were down 19%. And then this is kind of an interesting one because it happened so quickly. It was primarily the week before Christmas, although it started in October of 18, when President Trump got really serious with the tariffs in China. The markets dropped 19%. The next 12 months, however, these green are the returns from the bottom in the next 12 months. So 21% up, 29% up, 37% up, 33% up, 68.5%, 32, and 37. And this is the black box, and here is something that I really think we ought to all spend just a minute thinking about and trying to encourage our friends and family. This is a hypothetical illustration of $100,000 invested for 20 years from the beginning of 2000 to the end of 2019. $100,000 invested just in the S&P 500 would have tripled 324,000. There were 2,540 trading days over that 20 years. And if an investor missed just the 10 best days, out of those 2,540 trading days, they barely made money. Their $100,000 grew to 161,000, but it was over a 20-year period. And if you missed just the 25 best days, you actually lost money. Your 100,000 went to 82,000. How's that possible? This black box is just really fascinating. And we've lived through this last week on Monday, slightly on Tuesday and Wednesday. Over the last 20 years, 24 of the 25 worst trading days were either preceded or followed within 30 days of the 25 best trading days over the last 20 years. So when the markets were up 7.65% on Monday last week, that's a great example of, it would have been easy to say, why don't we get out till the dust settles? Well, the market grew 7.5% in one day, and that's been the trend for the last 20 plus years. So these were the headlines. Drew was able to go back and find some really powerful headlines from March of 09. And so if you'll remember, the markets had dropped nearly 55% from the top to the bottom. And this is what I think we really need to share with people. The headlines will be bad for a long time, even when the market has already left the station and taken off. And that, you could argue, has already happened. We'll only know for sure. But certainly headlines are not great. And I guess my encouragement is, I don't think people have started to really feel the pain financially. I don't think too many people have missed their car payments, missed their mortgage payments, missed their student loan payments. But that's all going to happen unless things just go back to normal very soon, which I don't think that's going to do. We're in a recession already. But I think we just have to understand that the news, the headlines, and what the market is actually doing are completely independent of one another, which is very hard to really internalize, but it's true. These are the headlines of the New York Times, March 6th. As I said, the bottom was on March 9 of 09. Job losses hit at vast remaking of economy. It didn't end. 5 million were unemployed in April. Obviously, we have 16 million unemployed now, but most experts would say that's a short-term situation. Once the doors open up, people will go back to work. Obviously, not all, but a lot. George Soros says the U.S. banks are basically insolvent. Chrysler filed for bankruptcy. Then GM filed for bankruptcy. Then depression became the word. This was 2 years after we had already been in the depression or the recession. Global economic shock worse than the Great Depression. So here's a headline saying that we're getting ready to get worse than the Great Depression. Ironically, from March the 6th to May 8th, the market was up 38.6%. So while these headlines were happening and trauma and carnage was getting ready to last for another 6 to 12 months in the economy, the markets had already been increasing by 38.6%. And as we said earlier, the next 10 months was up a cumulative 68.5%.
Jeff, and one thing to note that unemployment didn't reach its peak until 2010. So it was another several months while the market kept increasing before unemployment reached its peak and then started to eventually decline from there. So pretty powerful.
And I think this is what we just need to help people understand is unemployment's only going to go up. And I'm being a little more cynical now on what's going to happen in the economy, but I just think that we're going to have a lot of pain and people are going to suffer financially. I guess my encouragement to all of us and to share the message is that does not mean that the stock market is going to follow suit. It could, but the stock market will improve radically before people's lives return to normal. Key takeaway 3, historically, it does not take that long to recover from a bear market. The most significant gains tend to rise after the deepest declines. It's always darkest before the dawn, and I think it really is a good testament to just how this has happened in the last 3 weeks. Again, not to suggest that we're not going to have some testing of the lows or some pullbacks with the market over the next several weeks or months. But as Drew and I have been talking, the only people I think working harder than healthcare workers right now are investment bankers. They work hard anyway. That's a brutal, tough business. Analysts, the top MBAs in the world, love to go to New York and work for these Wall Street to figure out what these companies are going to do, what the profitability, how the regulation, deregulation, consumer spending, how that's all going to impact the stock market. We've been getting some really fascinating reports on all these investment firms about what profits are going to look like Q1, Q2, Q3, and 4 of this year, the last of this year, and early part of 2021. And I think people would be interested to know that the consensus for most of these firms, and of course they don't have a crystal ball either, but that profits of companies will be strong towards the end of this year and early next year, which is exactly why obviously the market has increased over the last 2 weeks. So how to survive a bear market: buy quality investments, be broadly diversified, have world-class asset managers through your funds and ETFs and your financial advisors. And then the one that's the hardest, particularly for men who we think we need to be doing something, if we're doing anything at all, we need to be making changes, is be patient. And this is something that we all know inherently, but just to kind of put it out here and talk through a strategy that we don't recommend because, as we said earlier, the markets tend to act very quickly and recover long before the headlines would say, or the lights would go on and say, hey, now's the time to buy. But strategy you obviously don't want to do is move money out of the stocks until dust settles. I get it. I understand why it makes sense and why people think that might be the right thing to do. But historically, the markets tend to rebound significantly before investors regain confidence. And I think this is just a great example going back particularly to 07, 08, and 09. People didn't feel confident for 7 years, and the market had its biggest growth in U.S. history. But here is an action item, and there's a lot of things that can be done, and I don't want to give the impression at all that you just have to kind of sit back and take your lumps. There are things like tax loss harvesting and investment and taxable accounts where, and we've been doing this aggressively, selling inside those funds. The managers will be selling losers that have lost value to offset gain to avoid adverse tax consequences this year and to go forward. So we love tax loss harvesting. We love rebalancing. We love making sure that adjustments, we're buying more on the equity side. All these things that are happening need to happen, but we want to be sure that they're smart, good, strategic portions of a well thought out plan as opposed to a knee-jerk reaction. So if you feel like you need to make any changes, obviously your advisor should be proactive in all the tax loss harvesting and the rebalancing and investment selection. But if you have any other questions, obviously feel free, and we encourage you to call and talk through it, because part of the thing that I struggle with is we're in these details, we read these studies, we read these reports, we've looked at this historical data ad nauseum and studied this for the last 2 decades. But if for most of our clients, they're not in this every day. And so trying to help share some of this historical perspective is helpful to give you some confidence. So I talked a little bit about tax loss harvesting. This is simply just taking the losses and putting those in our pocket for future gains, which there will be future gains. So Drew, you want to walk through the 5 essentials to successful management? Would that be helpful?
Yeah, I'd be happy to. Essential 1 is you must have faith in the future. So, the idea here is that we invest money because there's hope there that the economy, companies, good, solid companies as a whole, they're going to be worth more in the future than they are today. And as a stockholder, they're going to pay us dividends as our share of profits for owning that. And so, the whole market is built on optimism. So if we're pessimistic about what's going to happen, then we're going to miss out on a lot of these rebounds and opportunities that Jeff has discussed there. So there's obviously a lot to be feared in terms of the coronavirus and the recession, but we've seen the Federal Reserve act quickly on it. We've seen congressional tax on unemployment benefits happen, quickly. While sure nothing's happened perfect, it's happened, quickly. They tried to get on it, and energy cost decline. And so just looking back over 2008, 2009 crisis, history doesn't repeat itself perfectly, but it rhymes. And so we're able to look back and learn a lot of these lessons. So this is why we're seeing in a lot faster fashion, I think, a quick response to what's going on here, and using as many tools as we can in the tool belt to kind of get this thing turned around as quickly as possible. So a lot of reason to hope right now.
Well, Drew and I have a friend that's a developer, and 3 weeks ago, just an indication of, and it doesn't matter, I guess history will show who deserves credit, whether it was sometime in the Bush administration through Obama administration to Trump administration. You have the Senate and the House, you have the Fed, so you have these 3 players over the last decade. But 08 and 09 was a massive learning experience for the U.S. on how to survive. And so we have a real estate developer person who 3 weeks ago had already received relief on their building lease payments, and were able to turn those directly to their tenants. So before things even got messy, they were already receiving benefits. So the government has done an amazing job. And again, it doesn't matter politically, and it's not all from Congress, it's not all from the president, it's not all from the Fed, but everybody's been working in an unprecedented fashion and has learned quite a bit from 07, 08, and 09, how to avoid some of those mistakes.
And then obviously watching kind of what's happening around the globe. I mean, obviously a huge blessing that the U.S. wasn't the first one hit. And so we're able to sit back and study not only from a medical standpoint, but also an economic standpoint as well. Watching countries, get back to work. I know President Trump kind of laid out a phased program yesterday to be instituted by the governors on each state. But being able to sit back and kind of watch and study a little bit on how the U.S. can potentially and effectively do this well. And so we're already seeing in China some discretionary spending, just some good signs in the economy of things kind of turn around, which I believe is fueling a lot of this market growth. And even I think as we started this, Jeff, I was just looking here that the S&P 500 was up about 3% today, so that puts it over 31% from its bottom it reached in March 23rd. So good news today. So obviously looking for, in a perfect world, a cure for the coronavirus. And so we love this quote by John Morgan. It says, "To bet against America is to go broke." So we got our best and brightest working on this, which provides us a lot of hope and a lot of optimism that we're going to get a solution figured out.
Good.
So this is,
yeah, please go.
I was going to say this, the important thing with investing is you're trying to outpace your purchasing power. So this CPI number on the far right of your screen, this goes back to 1960. So you're looking at the past 60 years of market data. And so theoretically, just using CPI as a benchmark there for inflation, something that cost $1 in 1960 costs $9 today. That's how this works. And so in the investment world, all we're trying to do is look and say, what gives us the best shot of, one, outpacing inflation, and two, getting us to that place as fast as reasonably possible. And so if we just isolate the S&P 500, the 500 largest companies based in the US, if you look at the total return, the S&P 500 over that particular time period, its price return of 56%, 56 time multiple. So that's why, I got a question earlier today about inflation, and a lot of money's being pumped into the country over the past 10, 15 years. Surely inflation's going to creep up. It certainly might. But as we look back through history, still the greatest hedge against inflation is holding portfolios that have, sizable stock holdings in there. Because if we can get these multiples of 30, 40, 50 times the pricing of it when we initially started over the long term, that would have to be significant inflation for a long sustained period of time for us to not significantly outpace your purchasing power. And this is a good question. We get this a good bit, but I don't have, you look at these charts, we don't see, for everybody doesn't have a 40-year time horizon. What if I only have a 10-year time horizon? Go to that next chart there. So historically speaking, if long-term inflation is somewhere around 3%, is the number that you typically hear. So if we look at the S&P 500 over any 10-year period of time, 90% of the time, so 90%, we got only a 1 in 10 chance this doesn't work. That if we were, and this is if you're 100% in equity. So again, Jeff mentioned earlier, aside from, some situations, we advocate having a balanced approach. So if you were a very aggressive investor for the long term, you still have a 9 in 10 chance, a 90% chance that you are going to outpace inflation over any 10-year period. The vast majority of the time, significantly more than that. But putting things in perspective and kind of stepping back, saying, okay, only 1 out of 10 times, and this is if we're 100% in equities, might we underperform inflation for a period of time. And this is a chart we've been studying a lot. So there's a lot of numbers here, so bear with me. But on the left side of your screen, you'll see all these allocations that go from 100% in the S&P 500 and 0% in intermediate government term bonds to 0% bonds, 100%, or 0% in equities, 100% bonds. And it isolates 10, 20, 40, and 80 years of data going all the way back to 1940. And what you see here is that, especially when you kind of zoom out, so let's take a 20-year period, for instance. So there's a bad 20 years, that we experienced where we had the dot-com bubble in there. We also had the financial crisis in there. But if you take an average 60-40 portfolio, for instance, 60% in equities, 40% fixed income, if you would have invested, and it was a really bad time to invest because it was leading right into the financial crisis, and you stuck it through the financial crisis up through 2019, your average annual rate of return came out to be 6%, roughly 6%. And for about every 4 or 5 years up, we experienced 1 year down. So years with negative return. Of course, when you zoom out to a 40-year time horizon, as an equity investor, you've got a lot to look forward to. even with, balanced allocations of a 60-40, if you're a 55, 60, 65-year-old who's retiring, you're not necessarily going to 80, 90% bonds, especially in this low rate environment we're in. Keeping a healthy equity allocation, it would not be impossible to have 8, 9, 10% average annual returns over a 4-decade time period. So again, another reason just to stay optimistic right now, just simply looking at consumer balance sheets. We've got household debt's the lowest that it's been in recorded history, and banks are in a good spot. I can't tell you how many clients that Jeff and I have spoken to over the past 3 weeks that have been so thankful to have their houses paid for. And, I understand with rates being low, there's a lot of people out there that would say, gosh, borrow as much money as you can because it's at 3-4% and invest it all in the market. But there's a huge peace of mind rate of return that you can't quantify that comes with having your house paid for, if you can do it or do it before retirement. Because when we've minimized our outflows as much as possible, it makes a market downturn a lot easier to handle, knowing that we're living as cheaply as we can possibly live. So it's exciting for us to see, based on some national metrics, that household debt's the lowest that it's been in recorded history. That should make Dave Ramsey happy. So second essential is you must be patient. The stock market's always risen over the long run, so it can decline substantially in the short term, but over the long run, it's declined. So it's often said we don't know where the next 20% of the market's going to go, up or down, but we know that the next 100% is going to be up. It historically always has. So this is a Buffett quote. Market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people. I love that because it really hits on the human behavior there to want to take action or move to safety when the market's dropped and when negativity is in the headlines. But time and time again, we see the same process repeat itself over and over again, that the market rewards those that were patient. So then diversification. Our main two levers of diversification here are diversifying across equities, so U.S. and international equities, global equities, large companies, small companies, to bonds. And so we've seen bonds do in 2019 what we hold them for and what we like to see them do. A lot of people don't know that good quality bonds are up 4 or 5% year to date. And so if you've got $1 million portfolio that's in 60% in equities and 40% in bonds, yes, while your equities have dropped, your bonds are actually up 4 to 5%. So you have $400,000 in your portfolio that's actually made 4 or 5% and outpaced inflation for the year. So diversification becomes a key, obviously, especially as you get closer to actually needing this money. We want to drop less when the market drops. So you see here over the last 20 years, inflation was about 2%. So we need to outpace inflation to maintain and exceed purchasing power. Stocks over that 20-year period, again, 2 bad recessions in there, 6% rate of return on stocks. If you add some fixed income, you actually outperformed 100% stock portfolio because you dropped less in the down years. And if you diversified even further by adding in some international stocks and stocks of different size companies, you actually even outperformed just a plain vanilla 60-40 stock to bond mix. So diversification worked over the past 20 years. And to a point I made a minute ago, the worst 3-month period in that 20-year period for the S&P 500 dropped 30% in 3 months. Diversified portfolio would have been down 20. So not happy to drop a lot when the market drops. But it's worse 12 months, 43% drop back in the financial crisis, and roughly a 30% drop for a 60-40 diversified portfolio. And this is why this all worked. This is why I love this chart, because it hits on the financial, but it also hits on the emotional. That from 2000 to 2002, if somebody had invested in the S&P 500 index versus a 60-40 diversified portfolio, the index would have dropped 50% or 40% rather. The diversified portfolio dropped 18%. So the emotion is, I'm down. I'm not happy because I dropped. I lost money. So then in 2003 to 2007, bull market happens. The market increases drastically, 83% over a 5-6 year period. And a diversified portfolio went up about 74%. Remember, a large chunk of it's in bonds that typically don't rise as much as stocks do when stocks rise. And so the emotion there is, well, I'm glad I made money, but I didn't make as much as I could have. Process repeats itself in 2008, down 37 stocks, down 24, diversified portfolio. And then 2009, 2019, we go on this historic bull market run of 351% return in the S&P 500 index. And at a little shy of a 200% return in diversified portfolio. The emotion there is, well, I didn't make as much as I could have if I was on the market. But when you take that and all those returns over that 20-year period, put it together, you had a 211% increase in the S&P 500 and a 213% increase in diversified portfolio. So somebody theoretically in a diversified portfolio in this situation actually outperformed somebody who was 100% in the market. And they did so with significantly less risk. And that's actually why they did so. They did so because they dropped less in those big down years. Okay, so essential 4 is just use discipline and rebalance a portfolio at least once a year. So this is something that we're paying attention to and watching and adding value here. But if we invest initially in 60% stocks, 40% fixed income, that could be 50-50 now with the market declines. And so it's important to, sell bonds while they're up and buy stocks where they're down, or vice versa. When we have 2019 happen and equities go up 30% in 1 year, you could go from 60-40 to 70-30, for instance. We can sell stocks while they're high, buy bonds while they're, even though they had a great year, theoretically lower. And this is huge. We can't stress this enough. If you have, especially investments outside of retirement accounts, we say a lot, it's not how much you make, it's how much you keep in terms of your return. And so what we mean by keep is after costs and after taxes, how much are you actually keeping yourself? And there are investment strategies out there that can do really well, but when you look at them after the cost of the managers and the tax cost, might not be as big as advertised. And so a very important lesson there is to have a major focus on the tax and the cost of your portfolio. Jeff, you want to hit this?
Yeah, we'll just wrap up here. So we've got, I think, just as a reminder here, through all this, it has been interesting to talk to so many great clients that have kind of taken this opportunity to rewind and contemplate. And so I think we never take again for granted Friday nights with friends, birthday celebrations of the football stadiums, mornings at the gym, coffee with a friend, crowded concerts, or happy hours, although I guess everybody's doing those by Zoom now and just life itself. So we're just grateful and appreciate everyone. As we always say, we don't have a job if it's not for clients that we get to walk through this journey with. And this is where we can really add value of walking and sharing some of this intelligence and the reports and the analysis to help people be a good, successful investor and follow a carefully laid out financial plan. We went a few minutes over, although people can leave and bow out without hurting our feelings. But we'll see, Drew, just to be sure that we've answered, or if there's one more.
Yeah, we've got a couple questions I'll hit real quick. So one, is there a downside in the market to the dramatic increase in federal debt as a result of all this stimulus spending, or other negatives as for instance, one example being inflation?
It is interesting. Drew and I were studying some reports over the last week about the amount of debt, and we've been talking about this for 20 plus years, but obviously we'd rather have this, some of these solutions without massive debt. I think one thing that will benefit from this is that the majority, or at least a big portion of our debt, is Social Security, and I think this will help the Democrats and Republicans work together to realize that we have to push back for younger Americans, people in their 20s, 30s, maybe even in their 40s, when people could qualify for Social Security. Obviously, they shouldn't change anybody who's in their 50s or 60s or 70s, but that debt is one that would be something that we can radically delay. But because our GDP has been increasing so much, the debt, at least most of the institutional experts feel like it's sustainable. and I guess it was the best of two evils. I've got a fear, just as a taxpaying American, there's going to be a lot of fraud and a lot of waste, obviously, with the $2 trillion bailout and more to come. But at the same time, this was a pretty significant impact and a lot of carnage. And I think rational folks would say that the government needed to do something there. And so, but as a portion of GDP, obviously we'd like to lower it, but it just shows that inflation is something we've got to be careful of. And it goes back to the only way to outpace inflation over the long term is to own good quality stocks.
Good. We've got a couple questions on if these slides will be available after the meeting. So we're recording this, and we also have the slide deck. So if you would like to send the recording to somebody, let us know and we can send that to you. And then if you just simply want the copy of the slide decks, let us know and we can email that to you. So we'll take care of that. I had one question about when we were going through the diversified portfolio over that 20-year period compared to somebody investing in the market. Are the results with diversified portfolio similar when you're pulling retirement funds out during that 20-year period?
Yeah, real quickly, a housekeeping note, Drew, is we do have to submit this webinar to compliance, so we won't be able to email out the recording until the compliance is approved. So that'll be early next week. But the slide deck's approved, so we'll send this out right away to everybody here who joined. Yeah, and in fact, Drew, to your question about the returns on the market, that's why we've been so passionate, obsessed with being diversified, even when things were good, because when you have people retiring, and most of the people that we work with are retiring and withdrawing money, you have to be more careful about incorporating more bonds in the portfolio, so that way when the markets are decline, they don't decline as much, so you continue to withdraw. So those numbers would be even more magnified if you had withdrawals, if you were an uber aggressive investor. That can, and we happen to have a really traumatic period in the markets, your withdrawals can really be negatively impacting on your sustainability.
Good. That's it. That's all the questions that we had. Thanks so much, everybody, for joining.
We're grateful for all of you, and if we can help you, please call or email or reach out to see if we can talk through either yours or any family or friends that have questions. We just want to be a resource to be a good sounding board to make a rational, smart decisions. So grateful for everybody. Hang in there. Enjoy your weekend, and we'll hope to see you soon.
Thanks so much.